Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, March 24th, 2025. It is 10:22 a.m. Eastern Time. I'm starting the video. Wanted to get one out. We'll focus mainly on the equity markets and those things closer related, i.e., Bitcoin and the VIX. Like I've said, those are pretty much, if you will, sister trades due to the correlation and or inverse correlation in the case of the VIX. So let me start out. I'm going to start out with QQQ. I fired off a chart to you this morning, kind of sharpened the pencil there, gave you the levels. Still calling for that 6-7% bounce off the bottom, off the lows. So far, we're getting close. We're about 5.25. My max bounce target 7% would be the bottom. Remember the bottom of that very, very technically significant trading range there. As I've mentioned before in other videos, but I'm going to do it again. These things bear repeating. I know not everybody catches every video. All the subscribers on the site would not surprise me in the least to see them punch through there. Now, I'm going to tell you my trading strategy. I'm going to be out tomorrow all day. I have surgery, and they said I may or may not have to stay overnight in the hospital. So if I do, then I'm not going to be back on Wednesday, and I'm not sure yet how I'll be feeling. But so consider tomorrow, before I leave early, I might fire off one post if there's something I see. Otherwise, I will be no posts from me tomorrow, and hopefully I'll be getting back online Wednesday. That's yet to be determined. I will communicate my thoughts as soon as possible. But as always, what I do on this site, I strive to every extent that I can to provide foresight analysis, trading plans, levels to watch, developments that will, where we're going to go. You want hindsight analysis, turn on CNBC, listen to them, or, follow a lot of other services that'll tell you what happened today in the market. That does matter. I'm trying to tell you what might happen tomorrow. That's what we do. So these levels are there. The trading plan, and I talk about the benefits of being flexible, not being married to any one trading plan. I talk about my degree of certainty or lack thereof. Like I mentioned on Friday, I still was going home with my longs, but I decided to start hedging up, taking a small position in the VIX, which I plan to add to. We'll get to the VIX in a second. So all right, so here's where we're at. We are at the 200-day back testing the 200-day simple moving average. Let's just, for kicks and giggles, go back. I talk about that a lot. Those averages, they're sometimes you'll go through them a little bit, but once you're clearly below, they act as resistance, and it usually signals, again, clearly below, not a one-day intraday break, but several days or several weeks, and as I could say, the further away you get, the better. So now these are resistance, and again, as I said this morning, that's where in that last update about a week or two ago, the first arrow break there, and then possibly going a little higher. Wouldn't surprise me in the least if this is it right now. So let me say that. And how to trade it, there's a lot of ways. If you did come into the week long, the problem in markets like this, a lot of the big moves, like today's breakout. When I talk about the breakout, that's what I showed you here on the 60-minute chart. Remember last week, I said now we had two reaction highs there, and that's the level that needs to be triggered. So we gapped above it. And so what it does, the futures moved up gradually overnight and all that and into the morning. But ETF traders would have had to make a decision to chase it. It also tends to trap the shorts in. If you look at things like, let me just jump over to SQQ real quick. I told you that's a good proxy. I've been using that as kind of a trading proxy more than I usually do, just knowing what I know, that a lot of retail money, especially newbie traders, have flocked to these ETFs. Again, that's not my opinion. It's fact. Read about it. You can look at the volume or the total assets in each one. TQQQ was getting the lion's share. Like I said, I think it was a 20-25 multiple over SQQQ recently. So everybody was loaded long in TQQQ, and then so they're taking on the chin there. If the NASDAQ 100 drops 10%, which it did, over the SQQQ or TQQQ is going to drop 30 plus. And so those folks are feeling the pain. And then, like I said, a lot of traders, I could see the volume coming into SQQQ. So I gave you this chart last week, told you we were here. that a break of this trend line would take us down and backfill this thin zone. Remember, these 5-minute price histogram bars have morphed a little. They've changed because every day you're getting new, the data populates. But that was the initial target I was looking for. Then when I updated it the last time, I told you we hit my target, that backfill of the thin zone right there. Bounce, made a perfect back test, which was also an objective level to short or go, and then we hit that level again, bounced up. So what it gave us is this trading range. Now this is just upside down QQQ, right, in reverse. So those are the two recent highs in QQQ, and so these SQQQ traders got trapped. They went home thinking, okay, yeah, this market could, I told you, market felt like a heavy blanket, but what I did, it took a little bit, not a full hedge position, but a partial hedge in that VIX. And I'm going to speak again to that. I still like that. I think there's, relatively speaking, less downside in the VIX than upside potential in the stock market. So I'll get to that one second. And that's it. So you can see a big old gap. SQQ traders woke up to a 5+% gap, and they're at the next target, the next support level I had, which is also the 200-day on QQQ. But we'll probably come down here at minimum on SQQQ right there to that 33.29 level, I guess. And possibly you can see that the vomit price histogram bars down here on the left. You can see this is where they really start. So this is where we had that's comparable to that trading range in QQQ, which we broke down from. So kind of here to here is where we'll likely stop that pullback, my guess. And it'll become tough sledding. Now, anything's possible, and that's where you stay flexible. Right now, the market's rallying. The written headline, I always told you that and I've done this a long time, and the one thing I promised you is that if there is no real catalyst, and CNBC, the quote-unquote experts can't explain the reason for a big drop or rally, they will find one. They will assign anything, and sometimes they're almost laughable. At times I've seen them assign a cause to a rally or a drop that's almost contrary to what they've been saying lately. All of a sudden where rising rates have been bearish, and all of a sudden they're bullish for whatever reason because it denotes economic growth expectations or some BS. They'll literally flip their narrative around. Again, just because they're never going to come out rarely with their hands up saying, we have no idea why the market just dropped, big, huge drop today or big rally today. So just keep that in mind. News headlines are going to ebb and flow. They tend to align with the charts. One thing I'm going to say to that before I move on, just know this, that the latest is that there's hopes that Trump may kind of back off some of the tariff talks. Well, let me say this about Trump. Overall, I'm going to stay apolitical here. I think the guy's a douchebag personally, but I happen to favor his policies on balance much more so than Biden or what Harris would have done. So I'm kind of for that. And again, his method, maybe there is madness to his method, but a lot of what he's doing is working. But here's where I'm going with this, guys, is, okay, so let's just say, we know that in his first term, he benchmarked his success to the stock market. And we know he's shoved a big sock in his mouth because he's trying to get his things done that he promised. I get that, respect that, and he's taking some pain in the stock market. But yeah, he will cow down. I have little doubt on that, with the market being down as much as it is. And so we'll probably get what the rumors are, some kind of abatement in these tariff threats or the extent of what they will be. But one thing we know about him, even more so than his first term, because now he's a second termer. So when he's second termer, you had nothing to lose. Is that the one thing about him is he's erratic and uncertain. That's not going to change. So right now we may get a temporary relief rally with the tariffs, but it's in his nature to kind of things just fly out of his mouth. And I've always said this: the market. I've done this long enough through many cycles, presidential cycles. They really don't care. You want to think Republicans, because they tend to be pro-business more so, pro-growth. But you've seen what the market's done under various presidents. They really don't matter if it's Democrat or Republican. What the market's like is stability and predictability. They don't like uncertainty. And again, it's the scorpion and the frog kind of analogy. The Trump ain't going to change. Its colors aren't going to change. So I think we're looking at another 3 years plus of just kind of erratic stuff. And now that's all just my guess. I'm not a political expert, but again, that's who he is, and the markets aren't going to like that. And they thought they might like it early on, be okay with it, and then when push came to shove, and and we all know what happened. Again, the technicals priced in the correction. You can say what you want about that. We can sit there and try to argue or agree to disagree on that part. All I'm getting at is, yeah, we're going to continue to see uncertainty, and you're not going to try to ever you can't get in front of the headlines. I told you that before. Today you would have had to chase a big gap down, again, based on not even the actual announcement that he's made any changes, just the expectation that he might. I mean, that's, again, the assignment. That's the media assigning a cause for a rally. Again, that was already priced in. All right, let me go over the charts and the levels of watch. Again, since I'm not going to be here, you have to formulate your own trading plan. Preferred target zones, it means just that. That's ideally where I'd like to see us get before I move over. And again, to me, it's going to be a little different. If I'm going to be, out of commission tomorrow, possibly the next day, I'm going to tell you what I might normally do if I was in front of the computer, because it's hard to pivot. I can leave the desk with OCO orders. Those are one cancels the other. That'll if I hit a price target, it'll sell me out, and if we reverse and I hit a stop loss, it'll cancel, stop my position out. But so in a perfect world, we get there, and this is important, depending on how the charts look at the time, not just QQQ, but Apple, Nvidia, Microsoft, Amazon, Alphabet, Meta, Broadcom, Tesla. How do they look at the time? Are they all also approaching resistance? Do they have, are they near-term overbought on the shorter-term charts? Do they have negative divergence on any of the intraday time frames? Et cetera, et cetera, et cetera. What are Treasury bonds doing at that point in time? What's the S&P doing? Where's it at? So those are the factors that go in. But right now, and we may not even get there. Remember, we're at the 200s right now. The market so far is stalled out at the 200s. I'll get back to that in a second on the daily charts. But I'd like to see that. If we pull back, well, that's obviously the first support, that 480, 583, because that was those two previous reaction highs I was talking about last week. There's a gap right here. Traders love to buy gap backfills, and there's an uptrend line. So if you are looking and believe that there's more upside before all is said and done, before the next leg down the market, those are your buy-in or add-on points, or whatever you want to call it. Anything much below that, you might consider stopping out. You don't want to put your stop just below the trend line. Give it a little bit out of reach to allow the stop raids. There's a price support level right there. I'm going to add it right now. That would be no bueno if taken out. That's about 472.58, and then of course after that's the previous lows. On that preferred target zone, this top line here, you can see it over here, is the 38.2% Fibonacci retracement. That's from the all-time highs there, or that was all-time high to this low, and that's a run-of-the-mill. If this is what I expected, just a counter trend bounce. Counter-trend bounces typically end anywhere between the 38.2 fib retracement up to the 61.8, which is right here, this line right here. And as I was saying all along, before this bounce even started, expecting a kickback, that it wouldn't surprise me in the least if they run it up to back test that and go up a little bit. If we can get some momentum on this short covering rally, because a lot of traders will most likely be shorting at the back of that trading range, and the powers that be will want to blow out those stops, hit stop rates. So if they can pull the market up a little, they'll suck out a lot of short interest, get a lot of bulls hyped up that we've re-entered the trading range. And so again, that's the top of my max bounce target. So in other words, I will be, again, if I can set, over the next day or two, if it happens, I'll have orders preset to fill. If it happens on Wednesday, or I'm in front of my computer, or Thursday, or 2 weeks from now. This, again, as of now, my current trading plan is where I'll be scaling back in short from here up to here, but not anything above there. I may not immediately stop out. I may or may not. I'll assess the charts at the time, but that's kind of where I can easily see this rally going, and that would be where I'd probably be fully reloaded short, closed out the last of the longs. I told you I've been grabbing things like Tesla and some of these, high flyers that just had the snot beat out of them and were likely to bounce, of course, QQQ and all that. So that's it. There's the trading plan, guys, and where to go if we don't run right up there. I think there's a good chance, especially if that, there is some good news released on the tariff front. some actual news. But again, here today, gone tomorrow kind of stuff with all that lately. Um, but that's it. So there's your levels. I don't think there's much more to add to that. That's a target zone. It's just a resistance zone where we're likely to get some sellers stepping in and a likely reaction. And if we do, where to, get a reaction, hit that, pull back, come back in there. That would be a nice reentry and something like that. Again, one potential and likely scenario. Here's the QQQ. There's the 200. I started on this and then I sidetracked or got off topic. But there's a pullback to the 200 simple. You can see it right there, the red line. Pullback to the 200 simple with a ever so slight undercut. That's a bull trend. I've covered this almost ad nauseum for months now. These 200s. Traders just always traded around them, and especially in times of uncertainty. That's where I told you technical analysis, particularly my style, shines, because economists and analysts, they can't get their heads screwed on straight because everything's so much with the uncertainties. Again, the trade tariffs. What do you do? On today, off tomorrow. 25% today, off, and now 50%. Whatever country. It's just so. Good luck trying to trade the markets again on fundamental analysis. This is why, and it's one reason why technical analysis shines. The one things that are constant are the fact that for decades traders have bought pullbacks, especially after a big drop to the 200s, and they shorted once they went. Now remember, we had that little initial hurrah. There was a first bounce off there, that last hurrah, and then they got taken out, and now we're there. So that's it, guys. And if you wanted to know, if you put a gun to my head and said, Randy, you got to be full long or full short right now and throw away the key for 6 months, short right here, because we're back to the 200s. We can go up to that 200 simple, but that's what I would do. And I'm kind of speaking to the less active trader. I've been speaking to that again the whole time. If you're swinging, for the fences with the long-term targets I have that I haven't wavered on or changed, it's still a lot more downside to those longer term targets. And when you look at it from a weekly chart, it's still that potential bear flagging pattern. You had an initial leg down called a flagpole, what could be a bear flag continuation pattern, and then all of a sudden the bottom could fall out of the market any moment. And again, I can tell you right now, I wouldn't be starting to buy right now. If you weren't long last week coming into this or any of these opportunities here, you were already, what are we at? Over halfway up. We're, almost 5%. And I've been calling for about a 6 to 7% bounce. So what I was saying to you 2 weeks ago, maybe even 3 weeks ago, I no longer thought it was objective to remain short, especially to add new shorts, that the risk reward favored to the upside. They're just, not that we couldn't have gone down, but the downside was limited. And now it's that in reverse, in my opinion. So if you, carried some longs into this week, even if you chase this gap up this morning, nothing wrong with that. Probably maybe faded at some point in the day. I gave you levels, but there'll probably be a little more upside unless there's some bad headline that knocks it down. Okie doke, that's the levels. Again, you can see, let me just go back to here and finish up on that 200 thing. Last bear market we had was right here. And this time, the first kickback rally after the 200s were taken out, just like right now, the first kickback rally. Let me zoom in for you. Again, I believe this stuff bears repeating. We got it. Nope. I have to grab something here that's going to let me move this over. There it is. Okay, that was the last bear market. There was the drop below the 200s. Kick back. We actually hit the simple and the exponential are right next to each other. We hit them 1, 2. Both times it went a little. Simple's usually higher on a downtrend because it's a slower moving. It's just the calculation. The exponential moves a little faster to prices. And you hit the simple there again. Now somebody might have said, okay, well, I'm going to stay long till we hit the simple. I'm not going to reverse and go back short till we hit it. Well, guess what? You missed it there because then they, got a little bit above the 200 exponential and then they reversed it. So if I have a high degree of confidence that we're in a bear market with more to come, I'm not going to get greedy and go for that extra percent or two. I'll start shorting there and I may scale in up to and then not below that. Again, if that was my sole strategy, I'm looking at other things too, price levels, watching the price action, the market leading stocks. Let me go back here. And so you can see that was it. Rejection off the simple. Took them both back, took them both out in one fell swoop. Clearly traded above them, back tested the simple there. And so that's it. So now the simple, if we're going to go, and that's going to be the stopping point this time around, is about, or it is exactly another about 0.8%, 0.84 from where we're at right now. Just kind of give you an idea where the machines and humans may start stepping in. And that also, go back to my 60-minute chart. My preferred target zone is also about exactly that. You can see the pop-up box on the left, 0.82, top of it's 0.99, so there you go, 1%. It's about another 1% to the top of that preferred target zone. Okay, before we get to the VIX and Bitcoin, let's just look at the market leading stocks, the Mag 7, Mag 8, whatever you want to call them. Apple still well south of its 200s. I covered that last week, but everything got very oversold. With steep downtrend line, there's Apple kind of trying to clear that 219-ish resistance. But on the daily chart, remember, we became deeply oversold. And Apple is only going to go so far on the first oversold reading in a while. And that's where it's at. So you can see levels, there's minor, that line's not too good, it's decent, but more minor resistance. 200-day moving averages I'd watch on Apple. That's where it might stop, or likely to stop. Nvidia is testing the 200s, clearly took them out. It's been flirting with them for a while, clearly took out the 200s here. Back test rejected, back testing again on the 200 exponential. It's 200 simple, and the that massive, that key level, that's the bottom of the deep seep gap. This is our last official short entry on Nvidia. But again, like I said, as even not a very active, I kind of talk active trader. Sometimes I'm trading off 5-minute charts, day trading, 1-2 day trades lasting hours or a day or two. When I'm talking this kind of active trading is more of the 60-minute charts and the daily charts, where we kind of reversed, came the bounce. And so actually this is one that I've just started scaling back into. I had it short throughout, and took it there when I gave it to you guys, and covered here recently when I started reversing and going long. I'm adding here. I'm going to add all the way up to, but not above, right there, right now. That's my current trading plan. So there's my window of re-entering that. And again, it's just like the VIX, nibbling enough that I can add to. If we suddenly the bottom just falls out of this market, I'll have at least a starter position which I can add to, or I'll continue to add to on strength. I can tell you this is where I'd be really concerned. Anything above that downtrend line, that would be a stop out point for me. Microsoft took out the downtrend line just like the markets. Let's see, 60-minute chart. Remember I said last week, so many of these market leading, at least half of them had nice positive divergence. DL is divergent low, and bullish, aka positive divergence. Microsoft broke out last week, back tested. It's been one of the weaker of the Mag 8s, but it's also one of the more oversold ones. So you're going to get, just like Tesla, that's where I kind of, ones that are heavily shorted and nobody underloved, they tend to bounce pretty good on these little snapback rallies. So Microsoft's not up anything big today, but just trying to cover everything for you and give you the bigger picture, and still well below the 200. So again, near term, smaller, shorter term picture is, everything that's positive divergences on the 60, overbought conditions, extreme near term, extreme bearish sentiment, all that gives you a little relief rally. But bigger picture, and let's not forget, we're still below. Most of these stocks are below their 200s. The market's below the 200s. That's it. I don't need to really say much more than that. Amazon, and you'll see some retake their 200s. Again, it's a collective thing. It's not any one single stock. Oh, the market's bullish. But that was, beautiful. I highlighted that last week. Nice. Look at that well defined downtrend line. Popped above the 200. So you're going to see shorts scrambling to cover Amazon right now because they realized, I thought we were going to get rejected and stay under the 200. So that's what it looks like on the 60-minute chart. Beautiful, bullish falling wedge pattern, divergent low, breakout, back test, pop. And there's your targets. Max target if you're trading Amazon right there. I would be a seller if it gets that far. I do not have this one personally, but that's where I would be if I wanted to game a milk out try to milk out most of the bounce. That's where it would be. That's obviously the next target I have there, 205.61. And we took out this one today, about 200. Alphabet, same thing, bullish falling wedge, divergent low, breakout. That was the measured target. Is that what I did? Yeah, I did a measured target for you, I guess, in one of the videos. That was where the wedge broke out. That would take us up to about right there. If the measured target's hit, there's also a gap, top of a gap right there. That's a likely potential target. So these are all areas that, again, if you have any of these stocks, or if you're just trading the NASDAQ 100 collectively, if you start seeing these stocks hit these levels, that's where you're likely to see some profit taking. And if something else happens, I don't think that's going to, who knows? We'll see. Hopefully I'm back at my desk up and running on Wednesday. Meta breakout, bullish falling wedge, divergent low right there, gapped up. Breakout on the gap up is usually a pretty powerful thing. Why? Because it does two things. It traps short sellers that we're going to stay short as long as we're below that trend line, and it also denies longs an entry, and then they feel like they missed it and they want to chase. And so the shorts are getting cooked on this one today a little bit, and the longs are just waiting to buy any dip because it's broken back. So any dips are likely to get bought up again unless the things change around anytime soon. All right, Broadcom, nice resistance here if you're looking for one that hasn't yet taken off. I think this one, but also this is one on my radar to short soon when the recent lows and the 200s are taken out. So you can see, again, very nice big key reaction low, and it's compressing right here on this level. You have this ascending triangle pattern. If you draw an uptrend line off the lows right there, this is an ascending triangle. If they pop it, it's probably going to want to run. I mean, there's a little stop along the way, but you can see right there. Here's what it looks like on the daily chart. There's that big, beautiful primary uptrend line, purple right there, which we've been hugging on lately, along with the 200 days. This is massive support. So when the recent lows get taken out, you've taken out the primary bull market uptrend line that goes all the way back to the 2022 lows. And then you've also would have taken out the 200 simple and exponential, which are pinched together right now. And so that was one. But again, right now, the market's got a bid. There's a good chance they're going to pop that little triangle pattern there and run it up a little bit. Tesla, shorted, gave you these downside targets. Almost hit that, close enough to that T5. Was that my final? Yeah, that was my final target. And I told you this one I've been long recently, and downtrend line there. And T3 was resistance or support on the way down. Support once broken becomes resistance. And so Tesla is coming up to that level, the 200s. This is short covering, and dip buyers. Again, I talked about it, just the valuations. Say what you want about Musk and whatever, but it's a pretty profitable and solid, and still a very much a growth company, and down 55%. So, but that's it. So most of the run is the easy takings are milked off this one. You got the 200 simple and exponential, and a back test of this trend line. You can see here. I know it's a busy board. I call it a lot of lines, but I have an uptrend line off this low here in 2024, April 2024. That was taken out here. So this is that's it. Oh, the max upside for Tesla right now, I think, would be that downtrend line right there. So all in here. That's it. That rounds out the Mag 7. I told you back here, it was one of my favorite shorts was Netflix too. We had a bearish rising wedge. It's down quite a bit. Brief undercut of the uptrend line, but there it's right there now. I don't have much of an opinion or a position on Netflix at this moment. Let's talk the VIX, and we'll go to Bitcoin. VIX volatility index. I pointed that out on Friday as an objective, either pure play or my preference, hedged any long position. So I wanted to talk about this. Well, remember, we don't trade the spot VIX, but I'm just showing you this chart where we do have positive divergence. So this rally, if we're in a bear market, let's just go with that assumption, whether I'm right or wrong. From my experience, never trust a bear market rally. It's like when my kids were in kindergarten. I remember I told my boys, gave them some. It's going to be crude, but I think sage advice. Never, kids are sick all the time. Boys, don't trust a fart. when you have diarrhea. That's the kind of thing, because you guys know what that saying means. So it's the same thing. Don't trust a bear market rally, because just when they start to look good and you think it's safe to get back in the water, they usually boom out of nowhere. Again, I cannot say definitively that we're in a bear market. Just because we took out the 200s that's not a I have longer term, like the 20-month exponential moving average on the S&P 500 and the NASDAQ 100 on the monthly chart. That's a big one for me. I have primary uptrend lines that still haven't been taken out. So I just want to say that we can't say definitively. I think that I know the odds certainly increased when we took out the 200s. And so I'm going off that premise now, and I just wanted to, again, warn you of that. If you are trying to game this bounce long, it's going to feel great, look great. Kramer's going to tell you come out and buy, that everything's over and it was a great buying up and all that. And about that time, if it is a bear market, just when everyone feels comfortable again, warm and fuzzy, that's when the bottom falls out. So be careful there. All I can tell you, the VIX has positive divergence, bullish falling wedge. Remember, you don't trade the spot VIX. You can't. We could trade the VIX futures or the ETFs like VIXY that trade those futures. That's it. You still have also the positive divergence on VIXY here on this 60-minute chart. And it's down. It's down a little more now. The futures itself are down. What's the futures contracts down? About 4.36. So a little less on the near month futures. And which is actually, I consider relative outperformance, because the NASDAQ, well, remember, the VIX tracks the S&P 500. So if we want to compare apples to apples, it doesn't track it. The methodology is based on put and call buying on the S&P 500, not the NASDAQ. So the S&P 500 is up 1.7. So that's a big day. That's one of the biggest green days in a while in the S&P 500. And so relatively speaking, remember what I talked about the VIX quite a bit lately. You don't put $1 in the VIX and $1 short on SPY or QQQ or long. You take a fraction thereof. So if you reduce that down to 25, 1/4, or 30% position size, 1/3, then the VIX, and especially if you only took a starter position, which is all I suggested and told you what I did on Friday, the VIX, you're down just a little bit on that, and you're making a lot more on those index shorts. So what I do from here is I will start to, again, we're getting close to that time to start scaling back short. So what I do, in other words, guys, this is just me. If I had a high probability sell signal reversal point, then I would do an immediate reversal. A lot of times I do that with trades. You guys know that. I cover all shorts or a short and go full long. If I see something. And then there's other times like now where I kind of see a bounce target range and a little uncertainty and probably a little more upside. So I begin shifting, and I go from what we call a net, currently have been net long, back to a net short. I had a net short positioning there, pretty aggressive in the middle, started lightening up as I told you towards the end, then reversing long. And so I will be now moving from about where we are now, because I told you I started nibbling back on some shorts, and I will continue to up to those levels I told you, reversing back from net long to net short, and quite likely fully short there, meaning no long hedges, no long remaining positions or anything like that. That's my preferred style, is incremental, do each one tactically. Carvana is an example. I traded, I was short Carvana took that one before earnings, like I told you, laid it out to you as a pre-earnings trade, gave you targets on the 60-minute. We hit T1, T2, and then so I covered Carvana back here, but then I recently went long Carvana because we had nice positive bullish divergence. And so this is one that, although this is where I figured we'd probably start reversing, I closed out that long. I'm actually took a starter short, again, for the reason we could just reverse at any moment. And I will short up to, right now, this is my re-entry point where I'll be pretty heavy long if we get up all the way up there. We're back above the 200, but this thing moves above and below. I'm like, it's just volatile. And again, it had a constructive chart very oversold. First oversold reading since right here. And again, that's what traders are going to do, like Pavlov's dogs. Pavlov rings the bell, the dog salivates because they think it's time to be fed, because every other time he rang the bell, they got fed. Dip buyers, when the bell rings, and they're going to come in and do what they do until you get to the point in the bear market where it becomes what I call I make a lot of terms up. You guys heard me in the past talk about the POR. I call it point of recognition. The POR is where the masses, the majority of people, then realize, ruh-roh, something's different now. Buying the dip worked great. It's worked for so long. Buy this dip here, and they're going to buy it. But then if it does this, and they're down here, and they're going to maybe buy it one more. You get fewer and fewer. Some people a little more, I don't mean to be offensive, dense than others. And by the time the majority realize that buying the dip isn't working anymore, we're not going to new highs. They keep buying in. They're getting a little happy at first when they get a rally, and then they go underwater and they buy more, and they go deeper underwater. So the POR is going to be, for my analysis, is somewhere in here. Remember, we already hit T2. I've shared my longer term outlook on the Qs in the markets and where POR is likely to begin, somewhere in this area. I think about here-ish. And that's why I've told you before that we already hit T2 and T1 back here off that initial drop. This is just a marginal new and still divergent high that will probably a good chance run right through my third target. So again, if the markets play out like I think they will, and we hit that point of recognition where everyone just starts selling and support levels are getting smashed through, and then I would love to see a move down to T4 before covering for the next counter trend bounce like this one. So this one, especially if we get that bear flag action going, that might mesh with that. And so again, I'm getting 5 steps ahead right now. Right now, I'm more concerned about today, tomorrow, and the rest of this week. Okie doke. So that's it. So, Bitcoin, crypto. IBTI, as I've been stating repeatedly recently, to be bullish the stock market, especially tech and all things like that, is to be bullish crypto. It is still a longer term swing trade idea. We hit T3 to the button, reverse there for the same reasons of the stock market, positive divergence, and told you a likely and potential bounce targets is downtrend line. We're getting pretty close so far. You can say if you did cover and reverse at T3 that you either sidestepped a 15% give back of profits, or you turned around and made a nice 20-something% profit into now a 35% profit because you covered there in reverse. So Bitcoin is getting very close. I am not going to add any more. In fact, I may turn around and sell half my position right now, or some point today. We're getting too close. Problem with too close is so many eyes are going to see that trend line right there, that nice downtrend line. And also remember, this is comparable. This right here, this whole thing is comparable to that topping in QQQ, that trading range. And so all eyes are going to be on that right there, looking to and targeting that. And I don't like when too many eyes see the same level, you get people start stepping in early. So another way I look at it rationally is, okay, so am I going to hold out and try to milk out another 1.8 to the trend line, or maybe 3% to the 52.23 level? No. So that's that. There's your update on Bitcoin. Let me look at the futures in the crypto itself. BRR, Bitcoin futures. There's the downtrend line right there. You can see it pretty clearly. There's price resistance ish. I could, it's a okay level. This is really the bottom of the trading range there. You had a couple spikes below it. So again, this is the max likely bounce target. I'm going to borrow this trend line, or retask that trend line right there and put it over here. Make it like this. Yeah, that's a way better fit. Okay, this is right there. Clean it up a little bit. Okay, so if you're looking for a stop loss order or a reshort entry or add-on there, so you have this triangle pattern right here. And so downside break of that, bearish. Upside break would be bullish, but you still have, it's not one I would chase. You still have that bottom of that massive trading range there. So anywho, it's been a nice run on Bitcoin. That's BRR, Bitcoin futures. And I also track the crypto itself, BTC, that trades on the Paxos exchange. And that one is, this is a hourly chart. There's the primary downtrend line, all saying the same thing. So I just retasked that uptrend line like that on my Bitcoin futures. Let me do it here on BTC. There it is. All right, guys, there's your levels. And potential stopping points, objective exit points, short entries, whatever you want to call it, with an additional add-on there. Maybe take it to a full position if and when that downtrend line goes. So scale back, scale out of longs here, scale in shorts, add there. Okay, yeah, let's wrap it up here. That way I keep it focused. If I start getting into commodities, I'll start squirreling, and then I want to cover one thing or the other. I will point out Treasury bonds, too. I did notice today, TLT, NZB. TLT is your 30-year, the long bond, at this uptrend line right here. Nice down move, which means rates went up today, and with bond prices falling, it's at support. I'm still disengaging the bond sector. I'm not engaged. I mean, I have no position lately. I'm watching it for the market. If it does that, keeps falling, that's not good for the stock market. The 10-year has a little more room before it gets to its comparable trend line. Here, let me show you CB. Here, this is CB, the 30-year bond, long bond futures. Same thing. Uptrend line support, price support there. If it breaks that, just watch that. That's just net bearish for the stock market. That means rising rates. If we rally off here and head up, then that again, and I put a little asterisk in there. It's that it should be net bullish. But as I've said many times over, covering this chart here, the 10-year IEF, that any advance in IEF, meaning IEF up means yields down. If it's due to a flight to safety, that's net bearish and not bullish. Only an organic, natural lifting of bond prices, which means rates are dropping, is bullish for the stock market. But if it's a flight to safety bid, in other words, like we saw, institutions were buying treasuries as the stock market was falling, that's not bullish. That's a flight to safety bid. So, and then kind of here we are. We've been moving in and out. We're in my top of my green zone now, but threatening to drop back into the yellow zone, which these are levels I created over a year ago, where the stock market starts to take note of rising yields. So I just wanted to point that out, that yields are falling. There's that comparable uptrend line on IEF, the 10-year, which is more important really to the markets than the 30. But the 30 does matter, don't get me wrong. And I just want to highlight that. So just to me, something to keep an eye on. If we get down here to the trend line, I'll see what things look like at the time. All right, I will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.